Thanks so much for tuning into today's Talking Point. I'm your host, Neeraj Shah, and our guest today is Pankaj Murarka of Renaissance Investment Managers. Pankaj, it's been a really long time. Great having you today.
Thanks, Neeraj. Yeah, it's been a really long time since we last spoke. Pleasure being on your show.
Thank you. Pankaj, the Indian markets have done really well, relative or on absolute terms as well. I think ending flat in a year like this is probably great stuff. My question is, what is in store in the slightly near term, considering the fact that everybody's talking about a recessionary scenario, if not an actual recession? Does it impact a market and an economy like India, which is a lot more domestic as opposed to export, but has a significant exposure to export-oriented themes as well?
Sure, Neeraj. Very good question. Neeraj, we remain fairly optimistic about outlook for Indian equity markets going forward into the next year and probably over the next 2 to 3 years, I would say. And obviously, from a longer-term perspective, we remain a perma India bull. What you said about this recession in the developed world, let's say, probably I think it's almost a certainty that US and Europe will get into a recession some point of time next year. But what we really believe is, the recession that the developed world will face this time around will be very different than the recessions we have seen in the developed world in the last 20 years, primarily because last 20 years has been a deflationary cycle in the developed world. And not all, we firmly believe, and what we've been telling our investors is not all recessions are equal. So a recession in a deflationary environment versus the one which we're going to experience next year, which is a recession in inflationary environment, are very different. In a deflationary environment where developed economies are growing 1.5–2%, and you have inflation of 1.5%, which has been the case in the last 10–15 years, when you get a recession, you get earnings contraction of 5–10% in the developed world, and as a result, we see sharp correction in developed markets, let's say US or Europe. But this time around, I think there is a very high probability that despite a recession next year in US and Europe, nominal earnings will grow in US and Europe. And that's because you have an inflation which is at 5–6–7%. So even a 2 or 3% contraction in real growth will translate into absolute earnings growth in developed markets, which is why we are not bearish on developed markets as well, because my view is that most of these markets have made their recessionary lows during this year. And in that context, we think globally there will be a significant amount of capital that will flow back to emerging markets next year. And in that case, India will be a big beneficiary of that. And this time around, given the fact that India's weight in MSCI emerging markets has almost doubled from where it was pre-COVID, from 8% to 15% currently, for the same dollar that's allocated globally to emerging markets, India will get 2x the share. So India's share of capital coming to India this time around, when flows come into emerging markets, will be 2x what we saw earlier, and which effectively means we believe that there will be very strong flows, capital flows coming to Indian equity markets. And given the fact that while the world will be in recession, India will still deliver 6.5% or thereabouts growth next year. So we think India clearly is a standout case in terms of strong and very resilient growth. And I think India will get a significantly higher share of capital flows out of the global pool of capital that comes from emerging markets. And all of that makes us fairly bullish an outlook for Indian economy and as well as on Indian markets.
But these would be passive in nature, right? Because I think we were talking to UBS, which analyzed that about 95% of the current inflows global are still passive ETF flows, or not India dedicated, but EM dedicated flows. You reckon that nature will remain the same?
Yeah, that's partly right. But also what I would like to highlight is significant amount of active investors are wanting to get into India.
Individually, you're saying?
Absolutely. And these are like large sovereign funds. I can tell I've had conversations with 4 or 5 very large funds, each of them managing something like between $20 to $50 billion. And they have zero exposure to India, and they're wanting to invest into India. In fact, many of these investors are coming to India for the first time to visit and get a first-hand experience of India, because they realize sitting in New York or London that the next economic miracle, now that China is past its peak growth and probably next 10 years, best case Chinese growth to my mind will be not more than 4% average, which effectively means the next economic miracle happening is India over the next 10, 15 years. And they realize that they have either no exposure to India or a very negligible exposure to India. And all of them want to get a foot into India.
Wow.
So while a significant amount of passive flows will come to India, but I reckon that active managers will follow.
Okay. And I reckon flows is not the only reason why you're constructive on India. Do you reckon that earnings growth could actually justify the optimism? Because 2022, you would argue that despite the flows being negative, the markets have been benign, maybe buoyed by retail money, but be that as it may, the markets have been benign largely.
Yeah, that's right. But I think, see, last year when we talk about flows, probably from October of 21 to June of this year, FI sold something like about $36 billion into India, right? And this is the highest ever, much higher than 2x, almost 2x of what they sold last time in 2008 financial crisis. And yet our markets were down only 20%. So that clearly shows that our markets are matured and there's domestic money, long-term money, which is there in these markets. And $30-40 billion cannot move these markets significantly. And this market has capacity to absorb $30-40 billion of flows on either ways, on the buying or selling side. So I think that shows that Indian markets are matured and the depth has increased significantly. So that inspires confidence from many more global investors, because then they get a confidence that they can take their money out without having a significant impact cost and so on and so forth. I think what's attracting all of these guys and also leading to contributing to India's higher weightage in emerging markets and all of that is clearly the underlying strength of the economy. I think India is a secular growth story. Probably we would like it to be aspirationally much higher, but yet even if we say conservatively, India can comfortably do a 7% real growth over the next 10 years and probably higher, my view. You add to that 4-5% inflation, and I think India can comfortably do mid-teens kind of earnings growth at the Nifty index level over the next 10 years. And that then becomes a very powerful investment case, because you can't find 15% earnings CAGR over the next 10 years anywhere else in the world.
Yeah, that's true. Most certainly. What will lead this, Pankaj, to your mind? And there could be hiccups. I'm not getting into what the potential hiccups could be. It could well come in from an oil spike. It could come in if 2024 has a different election mandate. So a lot of things can happen. I'm not getting into that. As things stand right now, what will drive these earnings? Because the world, every single investor that I speak to seems to be parked in financials, which is a large weightage for our markets. And usually the rhetoric is that if everything is betting on one thing, it may not necessarily do well. Do you reckon that this time around the story or the script may be different in that everybody's betting on financials and they might actually turn up doing really well?
No, I think we also continue to remain positive on financials, because at the end of the day, if the economy does well, then finance is at the heart or at the core of the economy, because it has a role or a play or a contribution in each and every segment of the economy, because every economic activity centers in and around financials. So I think financials will do well, but I think this time around we see all the four engines fighting for Indian economy, and which is what makes me more sanguine on the outlook for the economy from a medium term to longer term perspective. So obviously we've had government expenditure or public expenditure and investment which has been growing even in the last decade, but what was missing was private sector investments. And I think that we've already started seeing initial signs of that kicking off, and I think that will become very significant and meaningful in terms of the kind of projects we are seeing at the drawing board stage and at the early stage of execution kind of things. I think over the next 5-10 years that starts kicking big time. Last 10 years, India's manufacturing as a share of India's economy is contracted from 19% to as low as 15%. With this whole PLI-led incentive schemes, and globally, you talk to all the Fortune 2000 companies, and China Plus One is on the agenda of the board and the CEO of all the top 2000 companies in the world. They want to debase or de-risk themselves from concentration of manufacturing in China, which effectively means India's manufacturing will have a very strong growth over the next 10 years, I think. And I think India is taking right policy initiatives to attract that kind of investments into the manufacturing sector in India. So I think India's manufacturing will start doing well. More importantly, by virtue of that, India's international trade or export growth, which was very stagnant for the last 7-8 years, now has started picking up. So I think international trade of foreign exports, which was not a driver of growth in that sense over the last 7-8 years, will become a meaningful contributor to India's growth over the next 4 to 5 years. And finally, I think consumption or household expenditure and investments will also grow meaningfully. So when I look at the Indian economy, I think we are in a sweet spot where I see all the four engines of growth firing and making a meaningful contribution to growth, and which is what makes me fairly sanguine that despite global headwinds, India will be a very resilient place in terms of underlying growth of the economy over the next 5, 7, 10 years.
What will benefit the most out of these four engines firing at one go? And I mean, lay it out as in terms of a pecking order.
So one, we are very bullish on capital goods as a sector because we think these are still early days for India's investment cycle. We think there is a very long road ahead for investment, the kind of investment that we see or we expect to happen in the economy, and we are seeing early signs of that. And there is, in the Industry 3.0, where manufacturing companies want to automate their shop floors, digitize their shop floors, their investments into green energy, where India potentially could become a leader, or clean energy when we talk about solar and wind and all of that. So there's significant amount of investments happening in the whole entire manufacturing chain, and new capacities coming up, be it across the heavy industries, be it cement, steel, and all of that, and the usual infrastructure stuff in terms of roads, which as it is we've been doing a good job. But apart from the urban infrastructure in terms of metros and all of that. So I think capital goods remains a big play for us over the next 10 years. Last year itself, the sector has outperformed, and while markets are flat, if you see the capital goods as a sector, stocks in the sector are up anywhere between 20 to 50, 60% in the last 1 year. So we're already seeing alpha playing out in names within the sector, and we think it's going to be a very strong theme over the next 5, 7 years from that perspective. So we're very positive on that.
But sorry, just before you go on, let me just so are you positive on those despite the fact that valuations are no longer as cheap as they were when you may have first made entry into it? I mean, for the MNCs, of course, they're very expensive, but even for the non-MNC ones, the valuations are not particularly cheap, Pankaj.
Yeah, you're right, Neeraj, but the starting point of valuations may be somewhat expensive to start with. Investors will have to be careful in picking the right stocks. But I still think in a lot of these names, there's significant amount of money to be made over a 5-year horizon, because I think the growth in these names will surprise on the upside. We are underestimating the growth that lies ahead of these companies. And secondly, because we've had a very bad cycle on investment side over the last 10 years, these companies have significant underutilization of capacity. Most of these companies are operating at 50, 60, 70% capacity utilization, which effectively means that growth plays out. There'll be a significant operating leverage which will play out in all of these companies, and where profit growth will be significantly ahead of revenue growth. So in context of that, yes, markets to some extent has priced that pretty much ahead of the cycle, and which is why valuations are expensive. But I still think there's a very healthy returns that can be made in these names over the next 5, 7 years.
Okay. Sorry, please continue. What else?
Second, we are again bullish on this whole India manufacturing. So across, it could be India manufacturing, it could be across, chemicals or electronics and so on and so forth, and the entire manufacturing ecosystem. So we believe that India's manufacturing, which is now 14% of GDP, goes back to something like 20 plus kind of a thing over the next 5, 7 years. Just take a classic example: the largest consumer product, the largest single consumer product that's manufactured and sold in the world is iPhone. India had zero contribution to iPhone manufacturing globally a few years back, and probably in 3 years' time we should be contributing 25% of global production of iPhones. And likewise, that's playing out across industries. So I think manufacturing in India is reached some sort of an inflection point because of confluence of multiple factors, and China plus one, where global companies want to have a second manufacturing base other than China, because they've been hugely concentrated in China, and they've realized the geopolitical risk, and COVID has shown us a risk of being concentrated into a single country, which these companies want to diversify from. So I think that's a big trend that will play out over the next 10 years. And finally, we're also bullish on internet businesses. We think India's internet economy is going to grow at 20% plus over the next 10 years, which effectively means if you look at the whole entire internet ecosystem, India's entire internet industry is about $100 billion of revenue. And our belief is that can grow at 20% plus CAGR over the next 7-8 years, and probably it could be an economy which could be $700 billion over the next 10 years. And if that be the case, then we think there's a huge amount of wealth that is to be created in this internet ecosystem. A large part of this wealth creation in the last decade has happened in private markets, but now these companies are getting public and getting listed, which effectively means the next round of wealth creation in the internet companies will happen in the public markets. And we are quite excited about that. I must say that investors, not every business will succeed, so investors have to be careful in picking the right businesses. But we think within the space, there's a huge amount of wealth that is to be created.
Yeah, and I reckon, Pankaj, that in that business, unlike capital goods, the starting point of valuations is looking a lot better than what it would have a year ago when they were in a frenzy of sorts.
Absolutely, Neeraj. So I think what essentially we saw at the start of the year or late last year was some of these companies got IPO'd, and because these were initial first few internet companies getting IPO'd, there was a huge amount of euphoria around them. And I also reckon it's my view that these IPOs were grossly mispriced. But because there was a frenzy and there were buyers, they got sold. But I think now there is a return to sanity where some of these companies are more reasonably priced in context of the underlying business and the future growth prospects. More importantly, I reckon incrementally now future IPOs in the space will be more fairly or reasonably priced in that sense. Having said that, I think the growth opportunities that lies ahead of this sector is phenomenal. I mean, after a very long time, I must say, I started my career as an IT analyst in the mid 90s. After a gap of almost 2 decades, I can visibly see a sector which can do 20% kind of a growth over a period of 10 years. I haven't seen that in the last 2 decades in Indian economy. So when I look at it, these businesses and this sector from a slightly longer term prism, I feel very excited, and it's been after a very long time I'm feeling so excited about such a sector, about a single sector from such a long term perspective.
But I mean, without getting into names, but do you like specifics? I mean, is food delivery something that you like, or is it fintech, or is it consumer tech? Where is it that you find favor?
We like all of these segments. It's all about picking the right businesses and right sectors. I must say we own some of these companies. So for example, in food tech, we own Zomato. I think the fact is consumers are going digital. Lot of things which we were doing in a physical real world, including yourself and myself, we've started now doing digitally. And as consumers adapt to digital mode and mechanism, I think businesses will have to go there. Businesses who already have a digital plan and model in place will significantly benefit from this pivot. Penetration or adoption of digital lifestyle in India is today exactly where it was in US in 2004. Last 10 years, last decade, 2010 to 2020, the best performing fund in the world was Nasdaq ETF.
Okay.
And if that be the case, then all these digital companies that are there in India, they're exactly at the same place where a lot of these US internet companies or digital companies were in US in 2005 or 2007. And the last 15 years, they've been the biggest wealth creators in US. And I think something like that can happen in India over the next 10, 15 years with many of these digital companies if they execute well.
Very interesting. My final question, Pankaj, and that is on the point that you mentioned that you started your career as an IT analyst and you are seeing these digital businesses having this potential for growth. What is your view on IT services? Because out there, the street seems to be skittish, maybe bearish. Management's not as much. And I heard you mention at the start of our conversation, and it may be different for IT companies, but I heard you mention that not all recessions are bad for emerging markets. Can you tell us what's your view on IT services?
Longer term, I remain extremely constructive on them. This is my hypothesis that in a world which is going digital, IT services companies are the new utilities. So Infosys or a TCS, which are global companies, now they are global utilities. So they are the NTPC of 1980s to my mind, because the world cannot live without this company, because every company in the world wants to go digital, and digital is not just one single transition, but it's something where you have to keep reinvesting in the business on a continuous basis, on a sustained basis to run your business. And these companies provide those services to the who's who of to the entire world, because Infosys or TCS or for the Indian IT companies for that matter, uh, 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 7 of the top 10 IT companies in the world comes from India. So these are global companies now dealing with global customers. So to my mind, these companies are digital utilities. They're exactly the same way one approached utilities in India or globally 20 years back. So the world cannot live without these companies. Obviously, because these companies have become very large and very mature, their growth rates have moderated to probably high single digit, low double digit in dollar terms, which I think is still very, very healthy. And these companies throw huge amount of cash. So I think nothing changes on that. There could be some cyclical impact on their growth for 4 to 6 quarters, because companies, global companies or their customers might want to reprioritize their spends for a short-term period. But otherwise, nothing changes for these companies from a longer-term perspective. So I think Indian IT sector as a whole can still grow at 10% US dollar terms over the next 10 years, and which is very healthy growth on such a large base that these companies have created.
Okay, Pankaj, always a pleasure talking to you. Thank you so much for being with us today and giving us your thoughts. Much appreciate your time.
Thank you, Neeraj. It was wonderful talking to you as always.
Likewise, as always. And viewers, thanks for tuning into this edition of The Talking Point.